Good morning and welcome to Stock Market Today. I am your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. You can find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to ChaikinAnalytics.com/today, where you can sign up for a free email. It gives you daily stock ideas for you to consider. Hits your inbox every trading day before the market opens. Longer with the curve steepening, the dollar was weaker versus the yen and the euro. Gold finished up 1.1%, bit of a flight to quality there, and crude oil was down 80 basis points, declining for a sixth consecutive day. And as we get to the desk this morning, seeing a little bit of follow through to the downside here. S&P futures lower by about 60 basis points after coming under pressure yesterday. Asian equities were lower overnight, led by South Korea and Australia. China remains closed for a holiday. European markets are under pressure here this morning as well. Treasuries are stronger across the curve. The dollar is weaker against the yen, stronger on the euro. Gold up another 10 basis points, and WTI crude trying to break that streak, up 40 basis points to start the day. And as we look at the S&P 500, we have entered the support zone that we've been highlighting. It feels like for weeks now, we've been highlighting 2,900 to 2,950 as key support. And we have entered that zone with the close at about 2940 yesterday on the S&P 500, and we are testing deeper into that area today. Resistance comes into play at 3,000, and then the July highs near 3030. What's interesting is on the pullback yesterday, the RSI remained in bullish ranges. Remember, 40 is the lower bound for bullish ranges for the RSI. So a continued hold above that level would increase the odds that support is going to hold for the S&P 500. Guaranteed to happen? Absolutely not, but we're playing an odds game here. Add to that the fact that Chaikin money flow is bullish and the indicators are still okay. I think today's going to be an important day to see how we react within this support zone. If we do not retake 2,950, 2,900 becomes the next key level to watch for the S&P 500. Our market in a minute. What am I writing about today in my note to Chaikin Analytics clients? Well, we're just touched on point number one, how we're in that key support zone to start the quarter, and all sectors finished lower. Now, nobody was safe yesterday, but it was defensive areas of the market that did outperform, staples and utilities in particular. It was that ISM manufacturing report that really got the market going to the downside, starting to bring back concerns of slowing growth and maybe even a contraction in growth. Sentiment indicators became more fearful, as you would expect. We'll take a look at one of those a little bit later in the show. And as I said, futures do point to a lower open here today. And as we shift over to the major indices from a power bar perspective, we can see that bearish tilt re-entering the market here, down 1.3% on the Dow Jones Industrial Average, 6 bears to 5 bulls. S&P gives back 1.2%, 98 bears to 91 bulls, so skewing back to the bearish side of the equation. NASDAQ was actually a slight outperformer yesterday. I know it's no consolation when you're down 80 basis points, but it did outperform on the day. 24 bearish and very bearish stocks there for 15, column 15 bullish or very bullish stocks. And small caps, for those of you who are longtime listeners of this show, you know I have not been a fan of small caps, especially on a relative basis. And you can really see when the market gets going to the downside, small caps are not the place to be. Down nearly 2% on the day yesterday. Still skewed in favor of the bulls, though, 510 to 403, but a massive deterioration on the day. Bonds ticked higher. Flight to safety sent yields lower. So according to the power bar, small cap stocks have become somewhat more bullish than large, and the major markets are mixed. Let's hit our stock of the day now, and this one should be no surprise to longtime followers of Chaikin Analytics and my work, because we have been bullish on aerospace and defense. We remain bullish on aerospace and defense, and Northrop Grumman is a name that we have highlighted multiple times over the past few months. Closed at 367.79, down 1.87% yesterday. Northrop has a very bullish Chaikin Power Gauge rating due to very strong earnings performance, very strong price volume activity, and very positive expert activity. Financial metrics are a little bit poor, but when we take the 20 factors, 5 in each of these 4 categories, we come out with a very bullish rating. So we have a very bullish stock, and the market and model are in agreement here is that very bullish rating, which we've been on since late April, coincides with a stock that's outperforming the market. Chaikin money flow has been persistently bullish throughout 2019, turning a little punk here in the near term. But for me, especially with the market choppy, I want to revisit Northrop when overbought, oversold indicator is in oversold territory. Now it's rounding out of overbought conditions, more middle of the road right now, still above a rising long-term trend line. So what we want is we want a very bullish stock that's outperforming the market, but we want it when it's oversold within the context of an uptrend, right? We want it back here in late August when it was oversold within the context of this uptrend. So that's the setup that we'll be looking for here. I think you take Northrop, if you don't already own it, and add it to a bullish watch list here today. If you're already in the name, it still looks good. The trend is still up. Move your stops up and manage risk. Taking a look at our sector tracker now, the movement of the major sectors over the last 5 days. So a little bit of change at the top of the list, but staples remain in the number one spot over the past couple of days. That defensive feel, a little bit surprised actually to see discretionary pop up, especially in light of the pressure that Amazon has been under of late. Technology near the top of the list. We highlighted tech yesterday, though, on a relative basis, how it was at a key inflection point. We really want to see, if you're bullish the market, you really want to see technology hold above that relative support level that we highlighted on the show yesterday. Rounding out the top five, though now negative over the past 5 days, utilities and real estate. So still a very defensive feel from a relative performance standpoint. Middle of the road, comms, materials, healthcare, and fins. I think that materials is one of the more interesting areas of the market here on a relative basis. I highlighted it in my note yesterday. Bottom of the list, industrials, as you would expect, under pressure when the manufacturing reading comes under pressure the way it did yesterday, and then energy just continued. There's no other way to put it, folks. Energy is a disaster from a technical perspective, from a fundamental perspective. It just remains an area of the market to which we do not want exposure on the long side of the portfolio. Whether we're looking at services, whether we're looking at EMP, whether we're looking at energy broadly, our model does not look good for that area of the market and is persistently and consistently been at the bottom of this list, and it continues to be there. Now, one of the areas of the market that's somewhat interesting to me because the fundamentals are good, we're just waiting for the market and model to get into agreement, is the regional bank services, our industry in focus today. And you can see from a fundamental standpoint, the power bar ratio is very strong. 59 bullish or very bullish stocks for 10 bearish or very bearish stocks. But the group has underperformed the S&P 500 by over 5.5% over the past 6 months. So that, why is that? Because of interest rates. Interest rates are under pressure. That is a headwind for the banking stocks. Now, we started to look at financials a little bit yesterday because their relative strength was starting to get better. We want to see that continue to improve throughout the financial complex, right? Not just insurance. We want to see the large banks. We want to see the small banks, right? We want to see names like FFWM and TBBK and First Horizon, FHN start to outperform. And we want to see the fund begin to outperform, right? Here's KRE, the regional bank ETF. It does have a bullish power gauge ETF rating, and you can see it's just been in this choppy consolidation. Now, relative to the SPY, it's been an underperformer, but what's interesting to me is over the past, call it month and a half, the intensity of that underperformance has started to diminish. Fund is oversold above a rising long-term trend line. If we can start to see some relative strength to line up with that bullish ETF rating, I think that this area starts to look compelling. But I think what you're going to need to see to really get some juice to the upside is for rates to back up. And with the manufacturing number that we got out of the ISM yesterday, I think that is a little too much to ask in the near term. Taking a look at what's trending now, yesterday's S&P 500 movers and shakers are gainers and losers. MKC beat and raised, sends the stock higher by nearly 7%. Insider buying on a beaten down Ulta sends that stock higher by 6%. Philip Morris PM caught an upgrade to send the stock higher by 2.5%. Visa reconsidering its relationship with Libra at Facebook. Investors like to hear that news. Up 1.3% in a down tape. Nectar, NKTR, talking about some executive changes. Get that stock flowing to the upside. Big story in the day yesterday was Charles Schwab, following on the heels of Interactive Brokers last week and cutting commissions to online trading to zero, that pressured the online brokers. E-Trade down 16.5%. Schwab down nearly 10%. Big theme. Everyone waiting to see what E-Trade is going to do because after the bell last night, TD Ameritrade came out and went to zero as well. Stands to reason that E-Trade is likely to follow suit, but no announcement there yet. XEC down 5.5%, no real news. FANG, COO resigns, down 5.5%, and APA down over 5% with oil. Let's look at the charts now. Sentiment becomes more fearful. What are we looking at here? We're looking at a 13-period moving average of the put-call ratio for CBOE equity options, right? A lot of people like to look at sentiment surveys. I don't. I look at them. Don't get me wrong. But what people say and what people actually do with their money are two different things. I like to look at tradables to get a sense of sentiment. I like to look at the VIX. I like to look at put call ratio, right? Because when this number is rising, when this line is heading higher, it means investors are gravitating towards puts rather than calls. That is a sign of fear in the marketplace. That is a sign that investors want to protect their portfolios or even bet on outright downside. Whatever it is, when we get to an extreme, it can become constructive or instructive as a contraindicator. Now, we are not at an extreme yet. Really, the cutoff here is 0.75 for this indicator. You can see in the past when that 0.75 level has been breached, right, most recently back in August, that tends to mark a local low for the S&P 500. Notice how it was breached back at the end of 2018, coinciding with that low around the holidays before the big rally ensued. So from a sentiment standpoint, we're not at an extreme yet, but we are watching closely because we're starting to gravitate towards that level. The moving average is at 0.67, but the actual metric itself is at 0.73. So something to keep an eye on, especially if we follow through to the downside today for the market. And the same is true on the downside, right? Below 60, really below 57.5 is a sign of extreme optimism in the market. That tends to mark local highs. I pay attention to this on a daily basis. I report on it on a weekly basis. I think it's something that all investors should pay attention to because, like I said, unlike the surveys, right? Somebody asks you, are you bullish? Are you bearish? You can pretty much say anything, and it might just depend on how you feel that day, but you don't actually act on it. The put call ratio is people actually putting money to work and making a bet to express their view. And to me, that is a lot more instructive than a survey where someone asks you if you're bullish or bearish. That's just one man's 2 cents. Now, some of the sectors and industries that we've been talking about, I think software is at an inflection point. Right, we've been talking about this one for a while. XSW starting to roll over. Right now, it's testing the 200-day moving average after breaking a near-term uptrend line. But notice the momentum. The RSI has put in a series of lower highs and now appears to be shifting to bearish ranges. And at the same time, software has gone from a market leader into a consolidation and is now underperforming. I think that one of the key areas of the market turning over, right, is something that we want to pay attention to, because I think if software breaks this 200-day moving average, we have more downside in the more aggressive areas of the market, the growth areas of the market. And as we take a quick look at shaken, 50 bearish stocks for 26 bullish stocks increases the odds that this underperformance is likely to continue. So we're watching closely as software tests the 200-day moving average. And what does that mean? That puts the Qs at key support in here in a consolidation above the 200-day moving average, but the RSI beginning to head lower as well. And on a relative basis, the Qs are at an inflection point, right, within this triangle consolidation. I think if the Qs give way and start to underperform, we'll see a further unwind of the growth trade that has been playing out over the past couple of weeks. So I'm watching the Qs closely here. That's going to wrap it up. Head over to shakenanalytics.com/today to sign up for that email. I look forward to coming back here with you all tomorrow.